In this video, we are going to look at a split study like no other. We've done a ton of split studies on our channel, which has to do with the policy design, how to maximize cash value, flexibility, all of that good stuff. But in this video, we're going to look at a 1090 versus a 2080, which is not what makes this one different, by the way. What makes this video different in this case study and the next video actually is we've got a backstory. So recently, I saw a case study from a company that I have a ton of respect for. The individual that put this case study together, I know him. He knows his stuff in and out. Just for confidentiality purposes, I'm not going to disclose his name or any information about him, but I know who he is, and he knows his stuff when it comes to cash value life insurance. And he had put numbers together with both MassMutual and Guardian and another company, but primarily Mass and Guardian, showing a 1090 versus a 2080 and really proving that the 2080 delivered greater long-term cash value than the 1090. And I heard that. Usually I hear that, I'm like, okay, I've got to see the numbers. But I heard it from him. I'm like, all right, you've got my attention because I know you know your stuff. So now I'm really going to dig in, and I want full transparency here. Don't play any games or anything like that. My point is, we're going to look at the case study that he provided, and this is really going to help you identify what to look for if you're ever looking for a properly designed policy and you hear and see this stuff as far as, hey, there's different ways to design policies. You don't want to go with a 1090, you should go with a 50-50, 20-80, whatever the split might be. What should you look for to ensure that your policy is truly designed for maximum cash value? Because there's so much noise and games that go on in this industry. So in this video, we're going to focus on the MassMutual examples that were prepared. We've got a MassMutual product, Legacy 100, we'll get to that in a second. It was on a 40-year-old male, best class, so ultra preferred, and the funding was $50,000 per year for 25 years. So paying into the policy up until the age of 65, and the specific point of the study was an internal rate of return analysis, proving that a 2080 does indeed produce more cash value long-term than a 1090. And it was one design that he put together in 20 minutes or something like that. So I'm like, all right, you really got to make sure you dig into this and prove it out properly. So the product selection is a Legacy 100 product. Rider selection. So when it comes to a MassMutual whole life insurance policy, there are two different term riders you can actually use. Their LISR and or their RTR, renewable term rider. LISR stands for life insurance supplement rider. If you'd like more information on those, our All About MassMutual video covers all of MassMutual's riders and products in full detail. So I'd encourage you to check that out. But my point is, depending on what riders you select, does have an impact on the funding period, long-term performance, but more importantly, the flexibility, which is something that's not touched on in this video. LISR provides a ton of flexibility, in my opinion, where RTR does not, but that's another topic. What we're going to look at here, 1090 split provided by the other individual, and then also 2080 provided by the other individual. And then we're going to take that exact same design and maximize it, or show, hey, is a 2080 truly better, or were things shown that were not completely transparent? So hopefully this really shows you what to look for if you're really digging into the weeds to find a maximum cash value policy. So here is what was presented by the other individual. It was a screenshot of a policy with the internal rate of return. So this is from MassMutual's IRR ledger. So as far as the details in respect to policy design, do you see anything there? As far as the death benefit, base premium, anything like that? No. Now, what we do see here is the internal rate of return. This is the 1090 design. We see $50,000 per year going in. First year cash value, about $44,200. That was an immediate red flag to me where I looked at that and I said, okay, the Legacy 100, when you set it up properly for a 40-year-old male, doesn't generate that much cash value. In every single case, it's typically below $44,000. So I looked at that and said, okay, it's a good design. I'd like to know more. What's going on? Unless you're funding it for 10 years or less, that's not going to happen. But first year cash value, negative 11.6 IRR, break-even point, Year 5, he's paid in $50K for 5 years, total of $250,000. He has $250,000. Now, as we scroll down here, the argument was the year 25 cash value, $2,075,000, internal rate of return, 3.70%. Okay, this is his 1090 design. Now, if we look at his 2080 design, exact same out of pocket, $50K per year, $40,000 right off the bat, which still looked at that and said, okay, something's off there. That does not look like a true 2080 split. Negative 19.7% IRR, break-even point, really between years 6 and 7. When I've got more cash value in the policy than what I've paid in. And to prove his point, the year 25 internal rate of return with the 2080 has caught up and surpassed the 1090 by only year 25. So this was the data that was used to prove just MassMutual. In our next video, we're going to look at Guardian, which is another story as far as what we saw. But this is exactly what was used to prove. So if you're a consumer looking at this, what is your thought? My thought, if I'm a consumer, is okay, the full detail or details are not provided here. So the policy type, it's a Legacy 100 that was used, but that's not on this. The base premium, the term rider blend, nothing's here. So fortunately, I've been doing this for a long time. I was able to look at this and figure out exactly what he did. And I'm not saying that oh, I know all this stuff because I'm doing it so long and I'm the expert. No, like anything, you do it for a long time, you can look at things on the surface and figure it out. So what we did was reverse engineer his policy. Here's the exact same thing. So we've got a Legacy 100, that's what he used. We've got 50,000, this is the same internal rate of return report, 50,000 going in. Identical cash value year 1, 44,198. IRR, negative 11.6. Year 25, $2,075,000. Internal rate of return, 3.70%. Going back to his screenshot, identical cash value year 1, going down to year 25. Okay, so we reverse engineered it. That's great. Here's what I really want to look at though. So going back to this guy, this is the IRR sheet. Let's look at the actual design of this policy, shall we? This is important. So anytime we look at a life insurance policy, if I'm the consumer trying to make sure that things are properly designed, I want to know, where is my money going? Because where can it go? Toward the premium or the PUA component. So let's break this down. Where we can see this, we see the 50,000 per year going in. Here's the premium, $3,830. He has a renewable term rider for $1,170. If you add those two together, it's $5,000. I want to add something here. This is actually a design that can be illustrated with MassMutual, but will not be approved for sale. Meaning, if I showed you this to say, hey, look at this cash value, and then you got approved and I submit it to MassMutual for you to start your actual policy, they would kick it back and say, this premium is too low. The lowest MassMutual will allow policyholders to go with policies for issue is a 10% base premium, not including the term rider. So, being me, if someone told me that, but I saw the numbers from MassMutual, I'd be like, okay, can you show me that in writing? Because when I just hear things like, I gotta see it, I need proof, that's just how I am. So this is a full illustration with MassMutual. Right now we're on page 12, we'll come back to this. But if you go down to the warning piece here, product warning. So we see, number one, what he put together was a mech, but it's really not. It is a mech, but it meched at year 55, and it was based on the tabular details, assuming that he continues to make payments forever. So that piece I didn't really like. But anyway, here's the point I want to highlight. Case design has Ailer/Lisser, which is MassMutual's PUA rider, in excess of 10x the base premium, and some more stuff, and will not be approved for sale. Please change the case design to meet the premium parameters. So we've got a design that's actually less than a 1090, but it's not valid. Like, you can't show people things that won't be approved. In my opinion, that's just using numbers that aren't real. Anyway, if we go back to the design piece here, so where's the money going? $38.30 base premium. Now, in his defense, what he did with MassMutual software is he designed it where he solved for an initial base premium of $5,000. Then he added this renewable term rider. This is free information if you're an agent. If you do that, what happens is that the software automatically nets the base premium and the term rider for $5,000. So he probably just did it real quick and then took a screenshot if he was putting the case study together quickly. It's a mistake that can happen if you're just moving too fast. But in any event, if you're gonna put a case study together, it has to be accurate. You cannot just skip over that stuff. So there's a $50K per year. If we go down to the year 25 value, identical cash value, $2,075,000 and change. We're gonna pull up a side-by-side spreadsheet shortly. So, identify the design. Last thing I wanna touch on with this is he's got a renewable term rider attached. So here we see that $1 million term rider, initially $1,170. That's the first year premium. If we scroll down to the outlay report, what do we see here? Here's why his 1090 did not look as strong long term, was not designed properly. So it's an unfair comparison, and I hate when that stuff's done because it's like you cannot manipulate illustrations to try and prove a point. So here we go, RTR. What MassMutual does here, keeps their premium level for 10 years with their RTR. That's not guaranteed, so it can increase beginning year 2, but then it begins to increase. So he has a $1 million term rider. What happens, by the time he hits age 65, the cost of that term rider is just about $6,100. Keep that in mind as we progress on to the 2080. Do you remember what the IRR was on the 2080 at year 25? 3.71%, $2,078,000. That's from his screenshot. Let's go back to that. $2,078,000, 3.71%. Being transparent with the data. We had to reverse engineer this because this is all that was presented. So there we go. We've got that presented there. If we go up to the policy design, there we go. Same thing with the renewable term rider. So he needed less term in this example because he has a higher base premium, but it's not a 20-80 split. The base premium, $91.81, and then the difference, he's got a $700,000 term rider that costs about $819. There we go. So, and then the rest goes toward Ailer. So everything looks the same in terms of cash value, but here's really what I want to look at. If we go down to the outlay report, come on, there we go. Here's the difference. Because he has less term on this example, initially it's about $820 for 10 years. Then as the years pass, does it ever hit $6,000? No, significantly less. So using a level term rider that's less than that 2080 is how he hit more cash value year 25. Now, should have took more time to dig into it. And it's not a shot toward him one bit. Again, he's done so much good in the industry that, like, I'm not being negative toward him. That's not the intent here. But you do need to really dig into policy design. So we've got his designs. Let's look at how to properly design it. So this is one I put together. Designed it differently, 1090. First year cash value, a little bit less than his 1090, 43,917. IRR, negative 12%, breaking even year 5. Very, very similar up front, and it always will be. What was his IRR? Year 25, 3.7 and 3.71. Keep in mind, these are the same products, same MEC limits, both right around $50,000, same out of pocket, same health rating, 40-year-old male, best class, all that good stuff. 3.88%, 2.127. So this is the kind of stuff, granted it's not a big difference there. If the numbers are bigger, then yeah, it's going to be more and more dramatic. But while it's not a big number, a big difference between the two, we look at it and think, okay, like the claim was made that a 2080 was stronger than a 1090 long term. Here it's not the case, not when it's properly designed. So we need to have transparency, what to look for with these type of policies. So is the policy properly designed? Is it a true 1090 split? Depending on the company, because all companies have different rules in this respect. So as we look at this guy, what do we see? Where's the money going? $5,000 base premium. We have LISR attached to this one, which is a 1-year term. There's the $50K per year going in. Death benefit, very similar to the last two guys. We're going to pull up a comparison and look at that quickly next. But very, very similar up front, different term rider, a design that will be approved for sale, non-MEC, all that good stuff. We don't have the warning because that's at a clean 10% base premium. Transparent, let's put it that way. Let's look at a comparison. Actually, let's look at the outlay report first, just to be transparent. I don't want to skip over or show one and then skip over mine. I wouldn't like it if someone did that to me. So here we go. There's your term rider on the far right. What do you notice? Starts out much less, $410. It's a blended PUA, 1-year term rider. Increases over time. Never even hits $4,000. We're gradually buying that term down. We can buy it down faster, but I wanted to make sure this did not MEC in any situation. So let's look at the comparison, shall we? What we're going to look at first is his argument. So this just makes life easy in that respect. Is we've got the other agent's breakdown, 1090 and 2080. Other agent, the 1090, violated the limits. Just want to be clear on that. Base premium was $38.30, $11.70 on the term rider, then it gradually increased. Breaking even year 5, same thing we looked at over here, that 2080, the one that he proved that the 2080 is better. Very, very quickly he put it together. There you go, breaking even between years 6 and 7. This column is valuable, cash value difference. This is going to show how much more or less is in cash value with the 2080 compared to the 1090. And these are the two designs he proposed, those two screenshots. So what do we see? The 2080 has this much less than the 1090 over here initially. But by the time we hit year 25, and this was his whole point, you've got a higher IRR and more cash value long term. Granted, it's so minimal, but still, there's his point. However, when we actually look at a true design that is compliant and passes the test, here we've got his 1090 compared to the same company, same product, just designed where it's actually compliant, $5,000 base premium. Here we go. Cash value difference, we've got a couple $100 less the first 3 years. And as you walk through year by year, what do you notice with the cash value difference? This is how much more you have with the 1090, with the true 10% base premium, the 1-year term rider for flexibility, everything set up properly, and the internal rate of return. Stronger all the way through. If we look at year 25, there you go. You're about $50,000 more in cash value. And it continues to be more all the way through. So more money from start to finish. Like that's really the thing there. If we look at the 2080 comparison, a lot of columns here. You can tell we were doing a full, thorough breakdown. We'll look at a simplified version next. But here we go. What do you notice? Same thing. I encourage you to focus your eyes on this column here and the column to the left of it, the internal rate of return. So you've got the 1090 on the right, the 2080 that was better than the 1090 long term, or at least it was claimed to be by an expert or a claim to be expert. Again, it's not a shot, but my point is, whenever you're doing research, trying to figure out the best possible policy design, this stuff is very, very deep. takes a lot of time to understand, to really get into it. And being able to identify the main pieces of a policy, of an illustration, is difficult to do for a lot of people in the business. So having someone that can go through this, identify that, kind of how I'll refer to, or how I admire Elizabeth Morgan and her firm when it comes to tax planning, business planning, any type of agreement. She knows what to look for. I trust her. She's a trusted advisor that she can look at anything and figure something out in 2 minutes that would take me a year to figure out. So I'm just going to ask her for the help. But anyway, that's another topic. Point is, this stuff can be deep, and if we don't have the time or really the desire to go through all of the weeds, but we want it set up properly, that's where we may need the support. Let's look at a simplified comparison, and then we shall wrap up with this. We're going to look at the guarantees as well, actually, but here we go. This takes out all the extra stuff. We've got the other agent's 1090, our 2080, and then the properly designed 1090. And what this is comparing our 1090 compared to the other 2080 that was proposed. What do you notice here? All the way through in purple is the cash value difference. You've got more money from start to finish. Long term, there's not much of a difference. But the main reason we put this case study together is because the claim was made very concretely that the 2080 very, very easily can outperform the 1090. It's like, no, it's not. It wasn't an apples to apples comparison. We've discussed before that we can take an illustration and manipulate it with term writers to make a higher base premium design, which pays me a higher commission, produce stronger long-term results. But then would I do that for myself to maximize my cash value? No possible way. So you must be transparent with the people that you're working with. Sorry, you can tell I get fired up with this stuff. Again, it's never ever a shot toward anyone. And the entrepreneurs that we work with will say, hey, that extra cash there, that's an opportunity cost I can use for other areas or use for my business, use for real estate. And when we wrap up with the guarantees here, it's amplified even further. What you will find when you look at the guaranteed cash values is a 1090 every single time is going to come out stronger. The simple reason why is it has to do with how dividends are really paid on base premium dollars. With the guaranteed cash values, we don't have any dividends, just the guaranteed rate. So how it's applied to the base premium component and PUA component is the same all the way through. So my point here, as we look at the difference here, if we look at the 25-year mark, there you go, you're at 40,000 plus, more in cash value, same company. This is what's so interesting. And more value all the way through. So I hope you enjoyed this one. Really the purpose here, or what I learned in this case study, is really to dig into it, whatever you're looking at, into full detail and make sure transparency is there. Or have someone that can do it for you. That way there's no games or anything like that going on. And the case study, the individual that put this case study together typically does not play games. I think this was just a case where he whipped it together really, really fast just to try and prove a point where it requires a lot more time, effort, digging into it, all of that good stuff. So I hope you enjoyed this one. I do hope that it helped in terms of providing more information and transparency. Please hit the like button, subscribe for more, and we'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom